The 5-day moving average, often referred to as the attack line, is a key indicator for short-term traders. Because it is highly sensitive and tracks a short time frame, price frequently crosses the 5-day moving average. But how do we distinguish a genuine breakout from a false one? Let's examine this chart. The yellow line, labeled MA5, represents the 5-day moving average. Here, the stock was in a downtrend, but one day, a small bullish candle broke above it. Was this a valid breakout? A real breakout would lead to further gains, while a false one would result in a decline. To determine its validity, we let the market test the breakout for us by observing the next trading day. In this case, although the price crossed above the 5-day moving average on the first day, the following day produced a bearish candle. This strongly suggests a false breakout. When a stock breaks above the 5-day moving average, a sustained upward move the next day signals a true breakout. If it fails to hold, like in this example, it's likely false. Now look at this other point. The price was also below the 5-day line before a bullish candle broke above it. Was this breakout real? The next day continued the upward momentum, indicating a valid breakout. As we can see, the short-term trend that followed was indeed rising. Since the 5-day moving average is a short-term indicator, we can usually judge breakouts by the very next day's price action. One thing to keep in mind, the validity of such signals is also short-lived. For instance, after this valid breakout, the upward move lasted only about 3 days. Similarly, the decline after the false breakout lasted roughly 2 days. That's why the sensitive nature of the 5-day moving average makes it especially useful for short-term trading. If you have any questions about using the 5-day moving average, feel free to leave a comment. We'd be happy to discuss.